Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on what's been happening in markets and what is about to happen for the week ahead. While I just let you have a look at the disclaimer, I'll just run through what we hope to get through in the next 30 minutes or so. We'll follow the normal format, so we'll just check out how markets are trading currently, and we'll just check out some of the news headlines before then going into stocks and earnings. And we'll look at, well, a few key points from the Q2 earnings season so far. Around two-thirds of S&P 500 companies reported actual results. So we'll just go through a few stats from those, and then we'll review those big earnings from MMAA, so Microsoft, Meta, Apple, and Amazon from last week. We'll run through just a very brief summary of the key points there, and also look at the charts associated with those four Mag 7 stocks, of course. And then we'll run through the stock indices as well, just some technicals around the charts there, the S&P 500, the Dow, and the NASDAQ. And then after that, we'll check out review really the data heavy, risk event heavy events from last week. So we'll look at the Fed, of course, we'll look at the dollar index, non-farm payroll, of course, on Friday, huge risk event in the end of that monthly employment report, of course. We'll look at the Bank of Japan meeting and dollar yen, Bank of Canada meeting and dollar CAD. And if we have time, Aussie inflation as well, so Aussie dollar. And that is all from last week, of course, before then looking at this week's main events. Much quieter calendar in a way, but obviously markets digesting, especially that non-farm payroll report, dire report really, and highlighting the weakness in the previous few months. But this week we do have a Bank of England meeting, so we'll look at cable, so that's sterling against the dollar. And we'll look at a couple of data points, actually, Canada jobs, and I think there's US ISM services out tomorrow. So a fair bit to get through. First of all, here's a quick rundown, of what I've just highlighted, really. And firstly, sort of overnight, weekend headlines dominated by President Trump again. On Sunday, he said he'll announce a new head of the BLS in the next 3 or 4 days. That's the Bureau of Labor Statistics. That is obviously after he announced the firing of the current head of the BLS. And there were lots of stories, in case you didn't read them, about the politicization of economic data possible, but also just how difficult a job it is, of course, to compile all these stats, especially after COVID, when lots of businesses, lots of consumers, especially as well, have stopped filling out these surveys, so the data is even more inaccurate, and therefore we get big revisions. And of course, that was highlighted on Friday with those revisions to May and June. We're getting to that detail shortly. But President Trump is set to announce a replacement for, as well, Fed's Kugler, who stepped down in the next few days. Kugler resigned, on Friday. So that'll be interesting, a replacement on the Fed board, and potentially possibility, lots of speculation about, of course, that being then a future head of the FOMC when Chair Powell steps down officially in May. Also, we've had a statement from OPEC Plus. So in oil, the 8 members are to raise oil output by nearly 550,000 barrels per day in September, citing steady global oil and current healthy market fundamentals. So we've just seen crude oil slip a touch. Stock markets, European bourses, they're mostly higher, with clear underperformance in Swiss stocks after a ramping up of tariffs from President Trump there. I think 39% on Switzerland, I think. So the SMI, that's the Swiss index, really suffering there as it returns from holiday. Otherwise, US futures are broadly higher, actually. US stock futures broadly higher after tanking on Friday after the data. Dollar as well, attempting to claw back some of Friday's lost ground. That sold off heavily after performing quite well last week, actually, and sort of quite a few analysts, Wall Street analysts especially, sort of thinking that this is the start of some sort of big dollar rebound. Of course, there are different viewpoints on that. We're kind of thinking possibly that's the end of its bounce back. and it may struggle with sort of longer term issues around Fed independence, of course, and around fiscal and monetary policy issues if and when the Fed cut rates. We'll get into that, as I say, shortly. Havens are lagging, actually, and there's clear underperformance in the Swissy, actually, as well, so the CHF. And just checking, bonds are pairing the non-farm payroll upside, actually, after yields collapse. The 2-year Treasury yield had one of its biggest moves in some time, many years, I think. And of course, the focus is on essentially the dovish implication of Fed Kugler's resignation and also that BLS firing. Okay, moving on from that to stocks then. I should say, sorry, just before I get into sort of a bit of the meat of the webinar, if you do have any questions, however big, small, whatever we're talking about or whatever you're looking at, please do ask them along the way, and we'll try and answer those, of course, as we go. So please, yeah, any questions through the webinar, then type those in the chat box, and we'll get to those at some point. Okay, earnings, Q2 earnings, as I said, around 66% of S&P 500 companies have now reported. Just some facts on that, 82% of those companies have reported positive EPS surprise, and 79% of S&P 500 companies reported positive revenue surprise. So decent numbers there. I think during the past week, we've obviously seen positive EPS surprises reported by 4 of the Mag 7. In IT, of course, those companies, consumer discretionary and communication services, they were also then the largest contributors to the increase in the overall earnings growth rate for the index over this period. That's sort of the scorecard earnings growth. So for Q2, again, the blended earnings growth rate for the S&P is over 10% now. The blended, that means those reported and those expected to report. That's a blended number. And if 10.3% is the actual growth rate for this quarter, it would actually mark the third straight quarter of double-digit earnings growth for the index. And then on revisions, well, on June 30, the estimated earnings growth rate for the S&P for Q2 was 4.9%. We've had that chart before. 9 sectors are reporting higher earnings today compared to June 30. And that's due to those positive EPS surprises. As for guidance, we did highlight guidance a while ago, there being a lack of guidance, obviously due to tariffs. And for Q3, then that's the next quarter, 30 of the S&P 500 companies have issued negative EPS guidance, and 27 have issued positive EPS guidance. So those are some stats, scorecard, if you like, of what we've seen so far. And they are from FactSet, actually. I've just got a chart, first of all, a broader chart, actually. Just before we get to this chart, I'll just run through some of those Mag 7 results as well. So bear with me when I pull up the chart. First up, Microsoft, of course, from last week. We had Microsoft and Meta after the Wednesday closing bell in the US last week. And then we had Apple and Amazon after the closing bell on Thursday last week. So first up, Microsoft. Let me just pull up the chart, which is here. And you can just see a fantastic spike higher, really, above 550 on those results, gapped higher. And then we just pulled back, obviously, after the sell-off on Friday. But Microsoft, well, they disclosed $75 billion in annual Azure revenue. And basically, the company joined NVIDIA in the $4 trillion market cap club, if you like. It remains basically the bottom line and the key takeaway from their results. It remains the standout in essentially turning AI hype into enterprise scale monetization. That's what you saw with that big jump higher, that all-time high. Then all the fives actually $555, but then obviously we've sold off on Friday, and we closed, at 524. You can see on Friday, so still above that previous all-time high, which was from the end of July at 518.29. Can't say too much, really. That's probably a decent level to look at, that previous high, 518.29. The blue line is the 50-day moving average, but that's some way below at 488.56 that you can see there. Meta, if I just pull up that chart, Again, decent results, up I think 11% on the close after they reported on the Thursday. You can see there, jump higher to all-time highs at 784 bucks and 75 cents, but then obviously just come back off that. You could just see, interestingly, sort of previous resistance from that February top, and then also that touch higher June top at 747 and 729. So there's probably a decent level of support potentially around there, 729, 747. Then you've got the blue line, the 50-day moving average, which capped the downside. Most recently, that's now just below $700. For Meta, they topped expectations and raised guidance, really betting big on AI infrastructure spend. That is interesting. We highlighted that last week, just on the fact that Google had done that, raised their capex on AI infrastructure by 10 billion. I think they did. Alphabet, that is, of course, 75 to 85 billion. And initially, the market didn't like it that much, but going through the day, actually, really. Initially was immediate after sort of grey market impact, but then on the day after Alphabet's results, the market like that. Betting big on AI infrastructure was then a call for these results that we saw last week. Meta did that, and that signaled confidence, of course, which the market liked, but of course it does elevate as well execution risks. And some of the super intelligence ideas that Meta came out with on its call, again of interest, but whether they can execute and whether or not it's a sort of Zuckerberg project which doesn't sort of bring fruitful rewards, shall we say. So at the moment, Meta getting definitely the love from investors, and that was shown in that 11% jump on its results. Apple, just moving to them, they reported on last Thursday. And you can see, well, they posted strong China sales and iPhone strength as well. That was a positive surprise for sure. Market's hesitation probably reflected one of two narratives. Basically, either was that pulled forward demand ahead of potential tariffs, so front loading essentially, and making then that quarter, Q2 quarter, hard to replicate, or are investors simply focused on AI leadership, where of course Apple appears to be lagging. We did compare this in our webinar that I did with Hebe Chen, the Australian analyst, last week, a preview of these four results. And it was just really interesting about just Apple being slightly different to some of these other Mag 7 stocks, which have been rewarded, of course, and the AI features, if you like, which have driven any stocks which have shown promise from AI, and in their bottom and top lines shown those hard numbers, they've been rewarded, whereas some of these other Mag 7 or even, technology stocks have lacked that sort of big gap higher because there is less sort of AI driving revenues, if you like. Apple, then, you can see the chart here, nowhere near those all-time highs at 260. And we just dipped now below that 50-day moving average, that blue line at 205.28. You've got a big fib level, actually, of this move lower from the record highs down to those April lows, that 61.8 retrace levels at 203.74, and we've moved through that as well now. So you've probably got swing lows around these lows from mid-June, around just below $200. Next support, if we do lose that with bearish momentum, you can see picking up quite strongly in Apple. Finally, Amazon. Just pull up that chart. Really nice ascending channel, bull channel, higher highs, higher lows. And it just looked like potential consolidation before a look at that record high from where are we? From that February high, this year's high, all-time high at 242.52. We just dipped, interestingly, below that 50-day moving average, the blue line at 217.61. So the black line, I should say, is the 200-day moving average. So that's at 209.57, potentially another line of support, which tallies with that swing low from June around sort of 207.31. Amazon's results, well, they offered mixed guidance. worrying investors really over AI related costs. That's exactly what I was saying earlier. Revenue beat, but cloud results disappointed. And the market kind of viewed this as a sign of potentially sort of slipping market share in that cloud race, which of course has boosted Amazon way, way above its sort of retail side and the tariff impact side and the China supply chain issues as well. So yeah, interesting on Amazon, and just slight worries over those AI related costs. As for the indices, let me just pull up a couple of those. So the S&P finally, well, couldn't manage to make yet more all-time highs. I've got a sort of bull channel in here, which I need to extend slightly. There we go. And tap some lows as well as the highs. Probably not a bad area. So you can just see, yeah, ascending channel, higher highs, higher lows. Most of these stocks, of course, since that April low, we've just broken down quite sharply through that bottom of that that bull channel. Really, we've got the previous high in there from February. That's the 61.47. This is in the S&P 500 cash, of course. Then you've got the blue line, the 50-day moving average, just below that, 61.29. So that should probably offer some support, if not initial support, to that swing low from mid-July, just above 6,200. That's the S&P 500. You can just see, yeah, we were overbought, and I know that we had a broken or an uninterrupted series of highs, which were rare and sort of warning of a correction. I just want to show you this chart as well that I have in the pack, which is basically a chart showing you in July, actually, the S&P had not moved. So here's, flatlining S&P 500 through July, and then obviously we moved higher. 1% is being the high move there on the day, and then down 1% is obviously below the zero line. And you can just see we haven't moved beyond, we haven't had any moves in July of greater than 1% up or down at all. It was actually for 23 trading days. Very, very rare occurrence. And really, again, we highlighted that in our weekly, actually, that, that was sort of denoting that at some point we would get some sort of sharper move greater than at least sort of up and down 1%. And that was ultimately down over 1% on Friday. Let's just pull up the other main indices as well. So we've got the NASDAQ. So the S&P was down 1.6% in the end Friday. NASDAQ down 1.96. And if I just pull this up, where are we? There we are. You can just see then similar up channel, and where are support levels now? You've got the previous high from February, again, all the twos, 22,222. You've got the 50-day moving average at 22,307. Probably not too bad. And if I extend that then to that record high, roughly, give or take then, yeah, interesting. The first, this would be, you've got to flip this the other way around, but the 78.6 would be the 23.6, which is a minor fib level, but that is around that recent high, well, that high from February, sorry. So sort of just above 22,000, 22,222, around that, 22,300 should be big, decent level zone of support for the NASDAQ. I'll switch that around next time and make it more accurate. Apologies about that. For the Dow, yeah, that sort of record high holds just above 45,000. We turned lower, and now we're, again, should flip this around, but it would be the 23.6 fib level. Just tallying with that 50-day moving average. 50-day is at 43,437, and then the minor fib level would be just below that, around 43,250 or so. Black line, 200-day moving average, just again, then below that of 42,882. Okay, let's move on now to last week's main events. So first up, we had, of course, the Fed, the FOMC. Yeah, and they kept rates on hold, as you all guys, everyone knows, of course, probably 4.25 to 4.5% the target range. Just for your guide. Interesting, Kubler did not vote, and then of course Waller and Bowman both dissented. We haven't seen that since I think it was 1993, I think. But anyway, rare dissent on the FOMC. They prefer to lower the Fed funds rate by 25 basis points. Just before we get to that, yeah, the Fed then, they said, just running through their statement, recent indicators suggest the growth of economic activity moderated in the first half of this year. Previously, they'd said actually that recent indicators suggest economic activity continue to expand at a solid pace. It's a slight difference there. And then they stated that inflation remains somewhat elevated while unemployment rate remains low and labour market conditions remain solid. Fed also stated that uncertainty about the economic outlook remains elevated. And then previously, actually, they said uncertainty about the economic outlook has diminished but remains elevated. So tiny tweaks there, but market does pay attention to these tweaks, hence why we're emphasizing and highlighting those. Fed Chair Powell, he ultimately said the economy is in a solid position and inflation is somewhat above target. Remember, of course, this is all before the non-farm payroll report. And he said the labour market is at or near maximum level, and he believes the current stance of policy leaves them well positioned to respond in a timely manner. He also said about the labour market that he was comfortable where it was, and he wasn't concerned about that. Ultimately, he was more concerned about inflation going for. He was concerned about inflation. Dual mandate was an issue, of course. Maximum employment, stable prices. That's the dual mandate. And he was actually on the labour market statistics pre non-farm. Remember. Said that the focus was on the jobless rate, the unemployment rate, more than the headline print, which was of course interesting. And then a lot of us were looking at that unemployment rate, of course, but then got shocked by the headline prints and the revisions. We'll get to that shortly. But Powell, otherwise, he said measures of longer run inflation expectations are consistent with the Fed's goal and sees the current stance again as appropriate to guard against inflation risks. I'll just pull up the dollar chart just for your guide. Which is here. This is the dollar index. Just then, finally, on the Fed, during the Q&A, Powell said policymakers have made no decisions about September and that meeting, and they expect to have more information coming up. He said they are still, and I quote him here, a ways away from seeing where things settle, with many uncertainties left to resolve, and feels like there is much more to come. He then said the majority was of the view that inflation is above target and maximum employment is at target, which calls basically for a modestly restrictive stance of policy for now. And that was in a way sort of in the face of President Trump, of course, who is, as we all know, very much banging the table loudly about rate cuts. So in a sense, in those comments, Powell was essentially saying they're looking through inflation because otherwise they'd possibly be moving rates higher. Not lower, but at the moment they're looking through inflation, trying to get a decent read on it over a few months. He did also say, and I should say, he said as a reasonable base case that tariffs are actually a one-time price impact, which is of course what some of the doves have been saying. But they want to see more evidence of this going forward. Bottom line, I guess it was a neutral hold. If we call it, some of these meetings, dovish hold, hawkish hike, hawkish cut, all those sort of phrases. This was probably a neutral hold. They want to see more evidence, as I say, but of course this was before the non-farm payroll report. So in a way, it was slightly stale, and we'll highlight why that is shortly. The dollar index for your guide. I always say this, but I like to repeat it. The dollar index has a heavy weighting towards the euro, around 56, 57%. So always bear that in mind. But it is, of course, very widely followed. index, you can just see this descending channel, lower lows, lower highs, broke out of that, looking as though we were forming some sort of base above 96. Just pulling this to a monthly chart, you can see this dotted line is actually a very long-term ascending upward trend line, if you like, touching those lows in 2011, then lows in 2021. So very much long-term line, but interestingly, it did hold prices from that started July low at 96.37. So we tapped that and we're looking as though we've bounced. But again, we've got a slightly less heavy dotted line, and this is from the low from July 2023. We thought it would be important and interesting. That's why we kept it there. It tallies with a fib level as well of this move lower. And you can just see that's around 99.63. 99.57, that low from 2023, and it has acted as resistance so far. So looking as though we were going to move above that and above 100 on this index, and then we've turned sharply lower on Friday after non-farm payroll, and we're now potentially getting towards that important blue line, the 50-day moving average. You can see it's capped the upside on a number of occasions this year. So now instead of resistance, it is support because we've broken above it so far. So that'll be interesting, the reaction to this level around 98.28, the 50-day moving average. If we break down through that, then of course we have those swing lows from late July, and then of course that long-term low at 96.37. Otherwise, upside, yeah, 99.63, 99.57 is probably just above there as well, that sort of resistance zone now. Okay, that's the Fed. Moving on to then non-farm payrolls. And we've got the graphic we showed you from last week, but obviously that was the preview, and this is a review of those numbers. Really important, huge report, really, and impossible, really, to deny that the July numbers were, exceptionally weak, really. Although the headline, as I've said here, was mediocre, 73,000 versus sort of 104 consensus expected. But the most striking thing, of course, huge, and I'll put it here in capitals, 258,000 downward revision to the past 2 months of data. So June job gains for your guide were originally printing at 147, they're now 14,000, 14 that is. May's initial report, that was 144,000. That is now just seen as 19,000, 19,000. So puts a completely different light, if you like, perspective on what has been happening in the US economy post really the April 2nd Liberation Day announcements, really. So yeah, headline sort of, and those revisions took all the headlines, if you like. Unemployment, well, as I said, we were watching that closely, but it rose 1/10 in line with expectations, 4.2%. And wage growth as well, in line, 0.3% month on month. I think the year on year was 3.9. So just briefly in detail, again, we highlighted this last week, just the quality of the jobs. So around 89, 90% of all jobs added in the past 31 months or so, so near 3 years, are from just a few areas of the economy: education and healthcare, government, leisure and hospitality. And they are not your typical growth driving sectors like manufacturing, technology, construction. So an important point there, I think, and potentially that's what we're going to see going forward. Obviously, these massive back month revisions kind of undermine what we've just said around the Fed and their key stance that the labour market has been solid, and that a preemptive cut, of course, a rate cut was not needed. As I said, Powell, he said the focus should be on the unemployment rate. Employment growth, he said, could simply be lower because the workforce is increasing more slowly. That's due to US immigration policy, and then not necessarily because hiring demand is falling. This is sort of Powell's premise, but that really can't explain that full weakness in the non-farm payrolls report through June and May. Of course, by Powell's logic, the Fed, I guess, would, maybe less phased by these growth figures than we might think. So Just bearing that in mind, of course, then the September non-farm payroll report, of course, assumes huge significance for then the September FOMC meeting, which is a few weeks later. And then possibly now markets looking at the risk of, well, catch-up cuts, if you like, is what we're calling them, similar to last year. So last year we got 100 basis points of rate cuts due to the jobless rate rise last summer that we saw. And we obviously got a 50 basis point cut as well initially. I should say we do have two CPI releases before the September FOMC as well, just for your guide. So it'll be interesting, really, whether we get that sort of tariff-driven inflation that we're seeing in some areas, which then forces the Fed possibly then to continue with modestly easier policy, or on the flip side, if that isn't as bad, say, and we get a bad September non-farm payroll report, then of course potentially we see deeper easing. And there you can just see the odds then of a September rate cut. You can just see ramped up from sort of 40%, so 10 basis points were priced in for the September meeting before this data, and that's doubled basically. So now an 80% chance, pretty much nailed on, really, you would think. Might ease back possibly through this week, but 80% chance of a 25 basis point cut, which is basically 20 basis points priced in. And again, for this year, that's nearly doubled, not quite. We had 33 basis points before the data, where the Fed, of course, was on neutral hold, but kind of the focus was on more inflation coming down the pipe, if you like, in the next few months. But now we've got nearly 60 basis points of cuts priced in for this year. So that is 225s, of course, and then a 40% chance of a third rate cut, all coming really initially after, let's not forget this non-farm payroll report. So it'd be interesting to see how that settles down through this week. Just moving on then to the Bank of Japan meeting. So we've moved on from non-farm payrolls on the Fed meeting, Bank of Japan. They pretty much it was fairly quiet. They paused as expected, basically to assess essentially how the trade deal will impact the economy and inflation. The latter is again the focus, with trade uncertainty, of course, easing slightly with the deal. So far, the bank's assessment of the trade impact is not actually especially negative. So it highlighted downside risks, growth risks, that is, but it did raise the financial year 2025 forecasts. And it also kept the FY26 and 27 forecasts unchanged, actually. The inflation forecast, though, they did get lifted with FY25 exceeding expectations, actually, that inflation revision higher, which means they see underlying price pressures still persisting. That probably is an interesting point, even though the initial reaction after the Bank of Japan was that it was slightly, dovish, really, or had disappointed, should we say. Domestic political concerns, they are possibly an issue going forward, really worries over Japan's fiscal condition. So, I've just highlighted here, and this was a chart actually from last week, but suitable because inflation remains elevated. And of course, we saw those upward revisions to their forecasts in the years ahead. As for dollar yen, bear with me 1 second, I'll pull that chart up. This pair is obviously influenced by US Treasuries a lot, or has been historically, should we say, not so much recently, but is now tallying with the 10-year US Treasury yield. And of course, that collapsed on Friday. So you can just see this move higher in dollar yen. We saw yen weakness and dollar strength really over the last week or so. We broke above that black line, which is the 200-day moving average. That's at 149.47 there, and that tallies with the halfway point of this move lower. That's at 149.37. So sort of resistance zone, and we got above it for 2 days, and then obviously we collapsed on Friday back through it. You've got a fib level here where we found support at 147.13. That is the 38.2 of this move lower. And then below that, you've got the 50-day moving average at 145.80, tallying with this swing low from late July at 145.85. Otherwise, yeah, resistance at that halfway point and the 200-day moving average around 149.37/47, if you like. That's dollar yen. Also had a Bank of Canada meeting. I'll just pull up dollar CAD, which is here. Again, policymakers left rates unchanged in Canada at the rate there at 2.75%, basically following on from ongoing trade tensions, of course, but also positive June data. So headline CPI actually ticked 0.2 higher to 1.9% in June, and jobs growth had come in stronger. The most recent jobs report, 83,000. We do get Canadian jobs on Friday for your guide. So kind of, yeah, it was a sort of dovish hold, really, seen by markets. The bank remains attentive to downside risks, with trade uncertainty a core concern, as conveyed by Governor Macklem in the press conference. And in fact, the Canadian economy looks set to have contracted in the second quarter. So the Bank of Canada's Q2 GDP growth forecast of negative 1.5%, well below the, I think the latest consensus prediction is around negative 0.5%. So really, they did leave the door open for more rate cuts if activity in the job market deteriorates. So watch out for that job market data on Friday. Just for your guide, employment increases in June in wholesale and retail trade, plus in the tariff-exposed manufacturing sector. Well, they saw that big increase in net new jobs added since January, but unemployment does still remain elevated in Canada, with more weakness potentially in industries sensitive to trade, of course. Bottom line, though, from the Bank of Canada meeting, yeah, they left the door open to more rate cuts, and potentially risks, well, or on both sides, but there's around 15, I think, 15 basis points, probably gone higher actually, 15 to 18 basis points now actually priced in by year end. Is that possibly too conservative? If the Fed start cutting in September, say, then many will think that Canada will have to follow suit at some point soon. So that sort of 18 basis points of rate cuts is possibly too conservative, as I've said. Okay, that's a dollar CAD, Bank of Canada, and all last week's main events. I did say I'd touch on Australian inflation, actually. Interesting, quite a big number because it was quarterly inflation data as well. That number, well, it eased by to 0.7% from 0.9% and fell shy of the expected 0.8%. That meant the yearly print retreated to 2.1 from 2.4%. That was actually the lowest annual inflation in Australia since 2021, actually Q1 in 2021. Probably more important is the trim mean and weighted median metrics, those core gauges, really. Those rose by 0.6% to be up 2.7%. So bottom line with these numbers is essentially they further solidified expectations for an August rate cut by the RBA. They unexpectedly actually left rates unchanged at 3.85% last time around, amid sort of risks for higher than expected Q2 CPI outcome. That's not what we really got, really. So yes, a rate cut I think is pretty much baked in for the RBA. Just on Aussie dollar, then you can just see this sort of upward, very gradual upward sort of channel being possibly broken now. We broke down through that blue line again, the 50-day moving average acting as support initially, but now resistance possibly to move higher. That's at 65.10, so spot 65.10. And then you've got that recent high just above 66 and support, yeah, 64.27, the halfway point of this move lower. And just below that, you've got the 200-day moving average there, the black line at 63.90. Okay, moving on then quickly to this week's main events. Bank of England meeting, which is here. and we'll look at the bits of data here. We've just got the chart, the inflation chart. Really, red line is headline CPI. Then we've got core CPI in here as well, the grey line, and then services CPI, which is still, as I say, sticky in inflation in the UK. That is the issue, really. Rising inflation and falling employment, really, at the heart of the Bank of England's, I put, dilemma, really, when policymakers meet on Thursday to set interest rates. Analysts are virtually unanimously expecting a 25 basis point cut. That would take the base rate to 4%. And would actually follow, and this is probably the most important point, it would follow the MPC's preference basically for cutting at a quarterly pace. So we see rate cuts every quarter, alongside meetings where we have the monetary policy report, the MPR meetings, essentially, which are every quarter, and we've seen rate cuts at each of those meetings over the last few meetings. Yeah, so 25 basis point cut expected, take base rates to 4%. Previously, they, as expected, kept rates unchanged. We had dovish dissent from 3 members, Dingra, Taylor, and Ramsden. Just from memory, they backed a 25 basis point cut, but the majority said to stand pat. There's actually no published consensus for a vote split, but potentially there is, again, a 3-way split incoming, or possibly a sort of 1-7-1 type split, with Mann voting for a hold, Dingra potentially back to a 50 basis point cut. I know some investment banks are saying that. Essentially, you've kind of got 3 camps, I think. On the MPC, you've got the gradual and careful cutters, who see 2-sided risks to inflation, people like Bailey. Then you've got the more cautious cutters, if you like, who might warn that further convincing evidence of labour market slack translates to price disinflation that's needed before then removing restrictiveness further, so more rate cuts. So there you've got the chief economist pill, for example. And then you have Taylor and Ramsden, who describe inflation risk as skewed to the downside. Data generally, well, that's underscored the sort of stubborn nature of inflation. So year-on-year CPI, advanced to 3.6% from 3.4 previously, and you can see services, steady actually at 4.7%. So it's this balance between slowdown in growth, of course, and the perceived loosening, really, in the labour market. Kind of think probably for now, the softening probably not enough to see them accelerate that sort of current pace, that current quarterly pace of rate cuts. So probably, I think the consensus thinks the statement will retain that guidance, which is rate cuts will be gradual and careful. That's probably those 3 key words to look out for in the headlines. If we don't see that, then potentially they're speeding up those rate cuts. Otherwise, as we are, if you like, as we were going forward, I think there's around sort of 46 basis points of cuts priced in by year end. Really key will be that gradual and careful phrase in the statement, I think, if we're not getting into too many more word changes and word tweaks. Let's just pull up a cable then. So there's the sterling against the dollar, of course, which is here. So you can just see the upward channel broken, really moved down through the 50-day moving average and found support on the 38.2, so a major fib level of this move lower now, potentially. That's at 131.40. We did find support there on Friday, of course, a move higher, although sterling lagged some of the other currencies. We're now nearing 133, so resistance here is probably around 134.34 is that previous high from September, and you've got a fib level at 133.86. Okay, I think we will wrap it up there. We do have as well ISM services data, actually. So that's non-manufacturing ISM. That's forecast to rise back, from 50.8 actually to 51.5. Orders did rebound in the last reports, but employment contracted for the third time this year over tariff uncertainty. Will be an interesting number, of course, after the non-farm payroll, and the sort of employment numbers within the report will be of interest for sure, as well as, of course, the prices paid elements. Remember, services accounts for more than 2/3 of the US economy. So, yeah, interesting report coming up on Tuesday, tomorrow. And remembering, of course, that PMI reading above 50 denotes growth, below 50 contraction. Okay, yeah, I think we'll wrap it up there. 45 minutes long, so longer than I did say. So really do appreciate everyone, all of you being on the call for sure. No questions as I see it, so hopefully that's been clear to you guys. Please do follow us on social media, lots of different channels, and we also write a daily report after the US close, has a look at all the major assets, the dollar, stocks, and also then a look to the day ahead and also a chart of the day. Again, thanks very much for tuning in, and we will be with you same time next week. Take care.